Heidi ho, everyone. Thank you, Mai, and welcome aboard. It's wonderful to have you here on this, the first day of August. So, pinch, punch. It's what you're supposed to do on the first day of the month. At least it was when I was a kid. I don't know if that's changed at all. And of course, if you're equine, I guess there's not too many of you who are equine out there listening, but if you are, have a wonderful birthday, what's left of it. And I hope you get lots of hay as your reward for turning whatever age you might be. I'm particularly interested on horses' birthdays because, well, I haven't really figured out why I lost so much money to them when I was young. So I just like it when they get older and older and older. July has gone and it ended with a bullish stock market, a bearish US dollar, a resilient crypto market, and gold for Australia and Japan. Yes, it's Olympics time, ladies and gents, but we probably won't be talking too much about that today. What we will be talking about, of course, is a whole lot of stuff to do with the markets. Firstly, we'll go to a macro view of those markets. And as always, it's wonderful to say g'day in New Zealand to my good mate, Julian. G'day, mate. How you doing?
Hey, Geoff, how are you? Hello, everybody. How is the world out there? I continue to be amazed at the at what is going on with an incredulous eye and also a fascinating and how can I make money out of this eye as well too. Folks, hey, look, today am I going to talk about macro? The short answer is no, I'm not. Right, what I'm going to talk about, for those of you that weren't there, I've just done a great Trader Cafe with Ash. Hopefully you pick up on that and you get the opportunity to listen to it. Ash, as always, has a number of different views about things and really, really clear descriptions about the world. And one of the key things that Ash said at the beginning was it's all about the liquidity. And I'm a huge fan of this argument, and I think we need to just take a step back some days and think about what that means. So liquidity generally, when you think about it in financial markets, is the amount of money washing around the place. That's really sort of the vague definition, right? When you think about that in more complicated terms, then really what you're doing is you're looking at sort of like bank deposits. You're looking at how well off people feel, what the money in their pocket is, what they're willing to spend. And also, if you're an institution or a fund manager, how much money you've got coming into your funds and how much you're then willing to put back into the markets as a result of that, right? And then furthermore, if you're a corporation, it's how much money can you borrow? How much does it cost to invest in projects that hopefully yield a little bit more and therefore get the right multiples for your business? So with all of those things, at the end of the day, it comes down to two things. It comes down to the psychology of the expectation of that liquidity being able to carry on. So you're going to spend money on your new car today if you believe that you're going to have more money going forward into the future. If you were a little bit more conservative and you said, I don't quite know about my future, you'd be less inclined to spend that much money on a new car. So I think what we've seen over the course of the last 18 months as the pandemic has unfolded is every single one of those emotions at both a private level, at a corporate level, and at a government level. And I think that's the key driver for me is when do you then turn around at the end of this and say, well, I'm not quite sure what the future holds anymore. Now things are a little bit less certain than they were. You walk back 18 months, I think people felt very uncertain back in March of 2020. And now I think people have a more mixed emotions. There's some parts of the economy and some people and some aspects of the international scene which are incredibly positive and looking great, and probably as the recovery unfolds going to do well going into the future, some time into the future. Well, cherish those areas, invest in them, and hopefully reap the rewards from it. But there's a lot of others who aren't. And I think from here on in, where we've seen the broad definition between call it pandemic friendly industries like digital and the Apples, the Googles and people like that, Facebooks have done tremendously well. And like they euphemistically call it the real economy, right? So think about things that hurt when you drop it on your foot, right? So a barrel of oil and also sugar and gold and all those other things, right? So where we look at the real economy on one side and that virtual economy on the other side, we've had that split. Well, I think that's going to stop. I think we're going to get into an environment whereby people are going to start to more cherry pick industries which are doing well. And therefore, as a result of it, because it's not so consensual, because it's not so widespread, you're going to need to have a slightly different approach. Now, what does that mean for the markets? It means that liquidity won't be as ubiquitous as it was before. It's going to be less widespread and freely available, which then will have consequences. So that will mean that at some point in time, the various asset classes, either on a rolling basis or a collective basis, will not like it, and they will then have a bit of a tantrum and then probably not do very well for a period of time. When that starts, what the catalyst is, I can't tell you for any of those things, but I think it's something for you to really keep a focus on. So when you look for things like liquidity, you're looking for changes in behavior. So the RBNZ, the Royal Bank of Canada, starting to withdraw their support of the bond markets, right? That's really important. Today, this minute, this hour, no. But over the course of time, it becomes important. The Fed beginning to talk about tapering, they're just beginning to talk about it, right? But New Zealand and Canada are already doing it, right? And that's the key thing. Okay, so what's happening to those currencies? What are we looking at? You could argue with a slightly firmer interest rate environment in New Zealand that it would not be unreasonable to think with the same level of interest rates as they have been elsewhere, that you'd expect the New Zealand dollar to do well. Now, we talked last week, I think, when we had a chat about this, about some of the relative value of some of those commodity dollar currencies and what they were looking at and where we thought some of those currencies were reasonable value, right? We know maybe the Australian dollar, maybe the New Zealand dollar has got to the point where they've sold off so much that they're starting to reverse again. We've begun to see that over this week, as we thought and we predicted in this show last time. So, let's just have a think about these, but it's going to become more specific, right? And that's what you've got to do. There's an opportunity probably in China and in Hong Kong at the moment. Those markets have sold off dramatically. But if you look at them in the sentiment cycle on a daily, weekly basis, we still have a little bit more work to do on the downside before they truly bottom. However, they're a lot cheaper than the markets elsewhere. And I think that's something else to bear in mind. I don't think the Chinese want to stall their economy out. I think they wanted to just make it better in the long run by regulating it more effectively. So think about what that means and how that works. So there's another aspect to it, right, within that. But you've got to overlay people's sensitivity towards the liquidity debate and also towards their confidence debate. Guys, I don't have a huge amount. Why don't I have a huge amount? Well, at the moment, we saw that US dollar turnaround last week. That's begun to unfold. Okay, we've also got Jackson Hole coming up in the middle of the month. That will be a critical time for the Fed. You could argue, if you wanted to, that the best way to get the Fed to stop tapering is for the market to sell off between now and then. I don't think nobody's specifically organizing that, but collectively, if that was to happen, that would give the Fed pause and they'd just close the book and say, right, we're still carrying on buying things. We'll see you in a year's time. So, something's important. So if that is the situation, then maybe Jackson Hole is something to watch as we lead into it, not for what they say and do at Jackson Hole, but what the market is doing beforehand and where its level of confidence sits. So bear that in mind, right? Equally, we need to look at what's happening to some of these inflation figures that are going on in the world. We've already seen new home sales in the States starting to stall. We're already seeing the PMI, so the Purchasing Managers Indexes in the States and elsewhere across the world, start to slow down. We're also seeing a lack of that so-called inflationary boost that everybody's talking about in America. That's also slowing down across the world. In America, it still seems to be going ahead. Month-on-month figures are still growing. But let's say that could be the last of it. There's a lot of stories out there about markets which are sort of alternately going crazy, 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 and then crashing. Just look at the lumber chart if you want to see something that really demonstrates that very clearly. So look, this is the reason why I said, having that holistic view is important. Looking for that information is important. Finding that key driver in the market, the one that's ruling the market right now, is pretty critical. I think liquidity is absolutely vital to see right now. Check out that information on savings rates in the States, right, where it appears that there were two major, through the stimulus checks that got sent out to people, spike in the savings rate. Well, it appears the savings rate has fallen back to where it was in 2019 now. So How about we rephrase that? Americans have spent the money. Okay, so what does that mean for tomorrow? Well, if you spent all your savings, you're not going to suddenly go out and spend X amount more, are you? Especially when prices are rising everywhere. You're going to have less money to spend. So think about how that works as well too. These are key factors we've got to get into our head about what's going on, and are we at one of those crucial tipping points now where we have to be alive? Now you'll say to me, Julian, I can't do any of that. I need to think about the technical picture because that's all I see in front of me. All that other stuff is too complicated and I can't figure it out. Okay then, so here's what we do. Go and look at that Chinese market and the Hang Seng and look at that in terms of the sentiment cycle. That's a technical piece of picture, right? Try and figure out where you are. This is a really good example right now because the sentiment cycle in China is at a way different place to the one in the US right now. Go and look at the one in the US as regards that sentiment cycle. Do some homework around that and maybe look at some of the European markets and see where they fit in as well too, right? Then we need to start looking at those long-term charts, the weekly charts on the foreign exchange. Has the Australian dollar gone far enough, right, to the downside before it reasserts its strength for whatever reason? At the moment, there's a sell-off because of COVID, but it won't be forever. The economy will come back. The country will come back. Do we need to start thinking about what that's going to look like from a technical perspective, right? And have we seen that bottom in the Australian market and possibly in the New Zealand market as well too? And maybe we've seen the top in dollar CAD for the near term as well. These are the things we've got to do. So what are we looking for whenever we're looking for that confirmation of that top? We're looking for a retest or a failure as we then get back up to that old high, or in the case of the Australian dollar, as we go back to that old low, we're looking for that failure. So in the case of the Aussie, it would be a higher low. In the case of the dollar CAD, it would be a lower high. Or we just managed to nick it, right? So the same thing, we get to roughly the same level and then fail, right? So we're really conscious to look at market failures for a new trend that may be starting in the opposite direction. Guys, look, that's it for me. I hope you understand what I've just been saying, and I hope that helps you both from a technical and a fundamental viewpoint. Don't forget non-farms on Friday. It's summertime in the Northern Hemisphere. A lot of people are on holiday. That's why a lot of people out there who normally talk are very quiet. And we've got Jackson Hole to look forward to in the end of the month.
Mate, thank you so much. You're talking a language that I do now understand, but I've got to say it took me a long while to understand it. And there are people in the world with the initials who, I won't even mention them, they've got the initials, Julian, McCree, who help you with those sorts of things. Thank you so much. Really appreciate it. That's invaluable information.